before we get into the markets and our trades for the future on Monday, let me talk about the GDP numbers we got out today. So we've printed a growth of 2.6 for the fourth quarter, which is a slight miss of the consensus of 3%, 3.2% or so. Bad number, but not horrible by any stretch of the measure by just looking at the 2.6 compared to the rest. So given that, we had 2.4% growth overall for 2014 versus 2.2 for 2013 and 2.3 for 2012. So last 3 years grown about 2.3% based on the government's figures. But I want to dig deeper into that number because there's some things in there that look a little fishy to me. And I mentioned on Thursday's video that the government's going to put out the GDP numbers that whatever they want it to be. And I'm going to show a couple of things that kind of make me scratch my head a little bit when I see this 2.6. First of all, the GDP deflator came in at a 0 with the consensus. They thought they were going to get a 1. And why that's fishy to me is that it's hard for me to believe based on previous government figures that the GDP deflator is not going to be a positive number. They're basically saying that the prices on October 1st were the exact same as they were on December 31st, and I find that hard to believe. But I don't really have any mathematical figures to back that up, and based on the price of oil from October 1st to December 31st, it's hard to deny that fact, because when you look at the October 1st, this was the price of oil right there, 90.7. So that's what it was on the 1st of October. Now, on December 31st, the price of oil was 52.81. Okay, that's about a 40% drop in the price of oil. Now, oil is a big factor in a lot of the pricing, so when you have that kind of a drop, it is, to give them the benefit of the doubt, it is certainly possible for there to be a 0 in the GDP deflator, but given their past history, it's hard for me to believe that. Another thing I want to look at is the personal consumption portion of the GDP. So this part of the GDP is basically where you add up all the goods and services that private citizens were spending money on in terms of either goods or services. So let me put up the government numbers. So I know there's a lot of numbers here, so I'm going to highlight the important things. So here's 2014. Here's the fourth quarter. Here's our 2.6 that we printed, and 2.87 came from personal consumption, and that is the largest print over the past 16 quarters, all the way since 2011. So no other quarter had a higher contribution to personal consumption than the fourth quarter of 2014. And that may sound all well and good, but that can't be true by any stretch of the words. And I'm going to show that to you here based on two things: retail sales and durable goods. All right, so let's start with retail sales. So this is the fourth quarter of the year, and it's the holiday shopping time, Christmas, Hanukkah, everything else. So you would think that it's going to be a high time for personal consumption. Unfortunately, that wasn't the case this year, as we've had the worst, the sales out of both online and retail for the Christmas season both missed expectations, and they were the worst. This was the worst Christmas since the Great Recession began. So here are the numbers. So here's retail sales, and we have October, November, and December. All right. So the retail sales number for October, the revised number was 0.5. The November number was 0.4. Now these are percentage increases month over month. So, for example, the amount of retail sales in October was 0.5% above what was spent in September. And so October was 0.5, that's the revised number. November was 0.4, that was the revised number. And December, we haven't gotten the revised number yet, but the first print was minus 0.9. So you can see that that was a big fat goose egg. Zero increase in retail sales throughout the fourth quarter. Now if you're looking at a growing economy, what are people going to spend money on if their paychecks are getting bigger? They're going to go to the retail store. They're going to buy clothes. They're going to buy shoes. They're going to go out to eat. They're going to buy a new car. They're going to buy more stuff. All right. So there's no way that with a 2.87 contribution to retail sale, to increase in personal consumption, that retail sales will be flat. Absolutely no way. Here's the even bigger kicker. Let's look at the durable goods for the fourth quarter. Now, durable goods are defined as anything that lasts more than 3 years. So your food is not going to be a durable good. Your clothing. Keep in mind these are all goods. These aren't services. But like your cars, your microwaves, your refrigerators, your furniture, all that stuff would be considered a durable good. All right. So October's revised number was 0.3. It was a 0.3% increase month over month. November was a minus 2.1 revised number. And December was even worse than that. That was a minus 3.4 for all durable goods. You add that up and you get a minus 5.2. All right. So the amount of durable goods spent per month is 5.2% less between quarters. Now here's what the government says. All right, let's go back to the look. So here's their goods. Here's your durable goods. So at a minus 5.2%, so a 5.2% decline in durable goods contributed a positive 0.54 to the GDP. There is absolutely no way that's possible. No way. All right. So something's fishy between the numbers. It can't be a positive 2.6 by any stretch of the words. And anyone living in real America knows that the economy is not growing that fast. And to top these two numbers off, one thing that also caught my eye on the GDP number was the increase in inventories. So the dollar amount was $113.1 billion increase in inventories between Q3 and Q4. Now that makes sense to me because they're preparing for a big Christmas year, but they didn't sell their stuff based on the retail sales and durable goods. So now they're just sitting on inventory. So what does that mean when you're sitting on inventory, especially on durable goods that are just sitting there? You're not going to need to make more of them in future quarters to sell. You already have the inventory. So that means that future quarters are not going to have the higher GDP growth because of that increase in the inventories. So overall, I don't think this GDP number was very good at all. Let's take a look at what happened to the markets on Friday. So had a bit of an up at the very beginning, right here. From there, some sideways movements, and then started back up. And then about an hour and a half before the market closed, big old tank right there. So gave up all the gains of the day, plus nearly all the gains from yesterday. So we closed at about 199.5. Close to that. We're getting very close to our support line right here. As I deemed in one of my previous videos, the yelling put. So watch out tomorrow. If it starts going down, then watch for somebody else to call up and boost the markets a little higher. They're nearly running out of people to call, so you never know who's going to say what to boost the markets higher. But they're not going to let this thing correct, or else, big panic is going to set in. But then again, if they want the market to tank, they're going to let it tank. And if they just continue to do nothing and say nothing, then the market will go very similar to what happened right here. This is what's going to happen if nobody says anything, or nobody decides to print any more money. But if history's any indication of what's going to happen in the future, look for them to talk up the money printing, because they can't lower rates anymore. So let's look at Friday's trade that we put on. It was on LinkedIn, so this is what it looked like on Thursday. And what I was looking at was a move of significance up, retracement back. It didn't quite hit the 78.6, so it doesn't cancel out the possible zigzag going up until we spread it out a little bit. What we looked at was the fact that we were going to cross over this resistance channel right here, and so that's the line that we were looking at right there. So 221 was the cross, and we were looking to go up because Thursday's close was 223. If it opened at the same spot it closed at, or anything above 221, then we were going to go up because it crossed above the resistance channel. It's our minute chart, and we said it was going to go up for the day. Alright, so it opens right there, and that's where I got in, because we said it was a Friday, that so unless you were trading the stocks, your stop was going to be 220, and so that's where it opened. The bid-ask spread was $1.12. The ask was 156. I got in at the ask, 156, right there, and then nearly immediately it starts going up, starts going our direction. And so as soon as it kind of paused right here was when I took a look and said, okay, maybe it's time to get out. Because once it starts stuttering like that, usually what I've found is that one of three things is going to happen. So let's draw this out. So we have big move up. That's where it opens. We have a big move up, and then it kind of starts stuttering like that. So what's going to happen is it's going to look one of these three ways. It's going to go like that, and then shoot up again. It's going to go up, stutter, retrace down, and then go back up. Or it's going to do something like this: stutter, stutter, and then just keep going down. So one of these things is going to happen. So it's going to shoot up, down, then up, or up, stutter, and then go down. So if this were a Monday, I would hold on and not get too worried, because I know what's going to happen with the pattern. However, because it's Friday, and when you're trading the option on a Friday, that time value is just going to start ticking away, tick, 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 and you don't want to be in forever. So if it's Friday, you're going to win. If it's that, you're going to win that way. However, if it's a Friday and you're trading option, you're going to lose. You're going to lose there, and you're going to lose there. Because even if this thing starts going up again, you're still going to lose on the time value. The amount of money you'll make on the way up in the movement of the price in your way. So if we go up in price, we're going to cancel that out in the exact same way with time, just simply because we're trading on Friday, and the option that I'm trading is the same one as expiration. So we pretty much have a 2/3 chance of giving back most of what we gained, either giving back everything we gained right here or giving back some of what we gained right here. So given that, as soon as it starts stuttering, and I know there's a massive move up, I'm going to look to get out. So we go back here, it does another one of these right there, and that's where I got out. Right there. I got out for 350. Now the way I got out is that I put in a limit order. So basically what I said is if you can sell it for 350, sell it. Otherwise you're not going to. So I got filled at 350, and I was drawing this right here, and then you can see what happened after that. Went down, back up, and then back down again. This is not something that you can throw $10,000 at and expect that kind of return in that sort of time frame. Not going to happen. Okay? Because in the first 5 minutes of this trade, of the option that I was trading, I traded the 222.5 call, January week 5, which is basically the last week of January. It expired on the Friday that we traded. There are only 70 trades that happened in the first 5 minutes. So 70 transactions of this particular option happened that way. And I just happened to be one of them. So got out, good return. Let's see what happened the rest of the day. It ended up going up, and it peaked around right there. Now had I stayed in, and more than doubling my money wasn't enough in the first 5 minutes, I could have made more. But coulda, woulda, shoulda. If I got out right there at 227, I could have sold for greater than 450. Or if I got out right there at 228, I could have sold for greater than 550. Now how do I get that? How do I get the 550 number? So here's the strike for our option right here, which is 225. So as long as it, at the end of the day, if it closes above 222.5, the option is worth something. It doesn't expire worthless. So every half a point, every point you go up here is what we call the intrinsic value of the option. And that's basically a point. For every point of stock, there's a dollar on the option. So if it's 223, the intrinsic value of that option is going to be 0.5. 224, it's 1.5 because 224 is 1.5 points above 222.5. So 227 is 4.5 points. So it's going to contribute at least $4.50 to the value of the option, plus whatever time value is left, about 4 hours worth before expiration. And then 228 is 5.5 points above 222.5, so it would be at least $5.50 for that. So it was certainly possible, but if this were a Monday, I would have kept in. But because it was a Friday, you know, you can't complain about more than doubling your money after 5 minutes. So the actual return on that trade was 125% profit. And then at the end of the day, it kind of tailed off. But it did what we said it was going to do. We got in. We got in the trade based on our technical definition. We had our stop. We had our exit. So that was a profitable trade. A lot better than the previous day where we broke even. Tomorrow's trading is going to be a little tricky, but it really reminds me of what happened last Wednesday when the Fed minutes came out. So if I want to go back to that day, which is right here, you can see this is Wednesday. This is the minutes, and it dropped three points on the S&P in the last 2 hours. And then you can see what happened the next day. It went down and then went back up. Now let's look back at Friday. Something very similar happened. So we had sideways trading until about 2:30 in the afternoon, and then after that it just went down. Excuse me here. There we go. Went down from 202 down to nearly 199. Another 3-point move. So, knowing that in mind, I messed up with you guys on Wednesday, and I don't intend to do that again today. So, here's what we're going to do. The market's either going to go like that, and then back up, or it's going to recover some losses, and then go back down. So, let me recolor these real quick. Maybe something like that. So we have blue where it goes up down, or red where it goes down up. Now, personally, I don't believe they're going to let the market slip below this line, because every time they do, somebody comes out, or there's some news that comes out right here, this 198 level or so, where it just mysteriously bounces back up. So that's what I'd say is going to happen, but I could be wrong, but that's what I'm banking on. So with that, my trade tomorrow is going to be on Facebook. Now, one of the reasons I looked at Facebook is because earnings came out on Wednesday afternoon after the market opened. So here's the earnings day right there, which is Thursday, and then a big move down the following day. So what I looked at is Facebook went down immediately on Thursday after they opened, then it came back up, sold off, and Friday's low was nearly exactly on the 61.8 mark right here at 75.72. So what I'm banking on is that it's not going to cross below the next one at 75, which is also a nice round number for the computers, although it really hasn't been support or resistance in the past. If you look over here, it kind of was right here a little bit, but not particularly, although it makes things a little easier when you're looking at what to trade. So what I'm going to do is I'm going to go bullish on Facebook with 75. We'll stop at about a point below a little below, more than a point below the close, 74.75. If that happens, clearly not the trend we're looking for, but that's what we're looking for tomorrow. Now, a lot can happen between when I post this video and when the market opens tomorrow. So if there's some news that comes out that's really good, or one of the Fed chairmen comes out and says something like that, and it opens significantly above where it closed on Friday, or you see some other news like that, cancel out of the trade, because the reward to risk isn't high enough for you to enter, although it still could go up. But assuming that we're in the trade, the way I'm going to trade this is that I'm going to look for something similar to what I've drawn here. So if it starts shooting up at the very beginning, I'm going to look to take my profits and run, because more than likely, assuming that nothing comes out or no news or anything like that, it's going to do this. So what we're going to do is we're going to capitalize on this move up. However, if it does one of these, like it did on Thursday after the Fed minutes came out the previous day, then we're still going to stay in and ride it all the way. Remember, it's a Monday, so you're not going to lose a lot on time value, so you can afford to stay in. But remember our hard stop at 74.75. If it goes below that, get out, and that'll be the trade for tomorrow. Good luck, everyone.